to the Ashok Leyland Q2FY22 Earnings Conference call hosted by Emkay Global Financial Services. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal the operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Raghunandan NL from Emkay Global Financial Services. Thank you, and over to you, sir.
Good morning, everyone. On behalf of Emkay Global Financial Services, we are pleased to invite you for the conference call of Ashok Leyland. We thank the management for providing us this opportunity. From the management team, we have with us Mr. Vipin Sondhi, MD and CEO, Mr. Gopal Mahadevan, Director and CFO, Mr. K.M. Balaji, Senior Vice President Finance. We request Mr. Vipin Sondhi for opening comments, post which we can open the session for Q&A. Over to you, Vipin, sir.
Good morning, namaste, ladies and gentlemen. Thank you, Raghu. Gives me great pleasure to be in touch with you once again through this post-result conference call, and I thank you very much for the interest shown in Ashok Leyland. And I hope all of you and your family members are safe, healthy, and it's important that we continue to focus on the vaccination process as well as social distancing. I'll quickly run you through the Q2 and half-year performance. Recovery in the MHCV domestic truck industry volumes, which has started in the second half of FY21, continued into Q2 of FY22 after a setback during the second wave of COVID, as you would all recall, in the Q1 of FY22. However, despite this setback, a significant growth in volumes was registered in Q1 in percentage terms, but due to the low base of last year. The MHCV domestic truck industry volumes in Q2 were higher than the corresponding quarter of last year by 116%. Historically, AL's market share in higher tonnage vehicles has always been higher than ICVs, and AL has a dominant presence in the south, as you know. Q2 FY22 witnessed a 15% shift in volumes from higher tonnage vehicles like tippers, tractors and MAVs, to ICVs, fueled by the increasing adoption of CNG. Volume contribution from the south to the total TIV in Q2 is lower vis-a-vis the same period last year. Both have impacted AL's truck market share in Q2, but I'm happy to share with you that we will be introducing products in the CNG segment in Q4 this year, and this should help grow our share of business. Increase in fuel prices added to the challenges, squeezing operators' profitability. However, volumes are returning to last year's H2 levels post the opening up of the country, and we are seeing demand increasing. With the economy set to grow to over 9% in FY22, we're quite positive about demand picking up. Our products, and you would remember we launched the Avtar range of trucks and the Bada Dost in the LCV segment. These were launched last year and are delivering excellent performance and have been very well received by our customers. And we will continue to launch new variants from these platforms. We are very, very happy and take great pride in the feedback that our customers are giving to us. The passenger segment, owing to COVID-19, continues to post lower volumes. As schools, colleges, offices open up and intercity travel increases, we should see better volumes. We are a large bus manufacturer, and therefore this improvement in the situation will positively impact AL. LCV volumes for Q2 FY22 was at 13,328 numbers, which was higher than last year, 10,952 by 22%. Our market share in LCV continues to steadily increase and in Q2 reached an all-time high of 23.3%. We will continue to grow this business as we have repeatedly proved our ability to introduce winner and industry-leading products. Our MHCV and LCV exports at 2227 numbers is 49% higher than Q2 of last year, which was 1491 numbers. Revenue for Q2 is at 4,458 crores, which is 57% higher than Q2 last year at 2,837 crores. EBITDA has improved to 135 crores, I repeat, 135 crores, 3% in Q2, up from minus 140 crores, minus 4.7% in Q1. Q2 EBITDA is also higher than Q2 of last year at 80 crores, 2.8%. PAT for the quarter was at minus 83 crores in Q2, vis-a-vis a loss of 282 crores in Q1 FY22 and a loss of 147 crores in Q2 FY21. The company has manufactured 12,048 MHCVs in Q2, 10,028 MHCVs during Q1, and has ended the quarter with an MHCV inventory of 2,958 numbers, 4,424 numbers in Q1. So inventories are down. Operating working capital for Q2 has significantly improved to approximately 32 crores from rupees 1130 crores in Q1, resulting in a generation of cash of over 1,000 crores in Q2. This resulted in paring down of debt. Capital expenditure for first half was contained at just 175 crores as compared to 290 crores during the same period last year. Investments in the first half of the current year was just 4 crores, vis-a-vis rupees 109 crores invested in the same period last year. Net debt is on 30th September 21 at 3112 crores, a gearing of 0.49 times, was lower by rupees 1063 crores when compared with 30th June 21, a level of 4175 crores, a gearing of 0.62 times then. Net debt as on 31st March 21 was at 2607 crores, a gearing of 0.37 times. The outlook, moving to the outlook. The truck segment is expected to lead the recovery in the coming months. MHCV truck volumes are likely to draw support from core activities covering construction, mining, not to forget the likely deferred replacement demand supporting the volume growth. Increased infrastructure outlay, a conducive financing environment, a scrappage policy in the offing, and rebound in economic growth are expected to support growth in industry volumes in the near term. The tipper segment is likely to benefit on the healthy traction in construction activity and mining. The tractor-trailer segment has been the worst impacted over the last couple of years. Demand from increased production in core sectors covering cement, steel and auto are expected to support the growth in this very, very important segment. We expect LCV truck segment volumes to grow further owing to the increasing demand for last mile transportation, especially from the e-commerce segment, as well as expectations of stable demand from agri and allied sectors. We've introduced new products in the MHCV segment spanning tippers to cement mixers and also in the e-commerce range. We continue to watch the global and Indian semiconductor situation, which has impacted many industries worldwide, from mobile phones to PCs to cars to commercial vehicles. With COVID vaccinations gaining pace and the government's focus now on the second vaccine shot, we believe the COVID-19 impact should soon wane gradually and people's confidence to restore normalcy in their lives will swiftly increase. Going forward, we foresee tremendous opportunities. We will continue to grow exports, defense, PSB, LCV and parts, even as we expand the reach and products of our core MHCV business. Our focus on digital will help leverage the benefits of efficiency and cost. Customer requirements will be at the core of all our digital initiatives. Our electric vehicle business through Switch Mobility is doing well and gaining orders in India and overseas. It has made an impact in COP26 held recently in Glasgow, and we are providing a sharp focus to this business, which is the reason we've hived off the EV assets to switch and own. We at Ashok Leyland are rock solid and resilient and are confident and extremely well positioned as a pure play CV player with new gen products and talented people to deliver profitable growth as the market revives. And I thank you very much for the interest shown on Ashok Leyland. And with this brief, I open the floor to questions. My colleague, Director and CFO Gopal Mahadevan is with me, and Senior Vice President Balaji is also present. Over to you. Back to you, Raghu.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in this conference, we request you to limit your questions to 2 per participant only. The first question is from the line of Hitesh Goel from CLSA. Please go ahead.
Thank you. Good morning, everyone, and thank you for taking my question. My question is basically on the replacement demand, which actually was highlighted in the summary which was given by the MD. I just wanted to understand what kind of what would be the proportion of replacement demand in next few years, because if replacement demand comes back in full in next few years, you could see a very significant growth in next 2 years in CV. So how do you track that, and what is the indications from the ground on that?
See, this is a very good question, Hitesh, and we are also kind of expecting that the replacement demand will also start kicking in for the following reasons. One, as we have mentioned previously in the calls, we're seeing a huge change in technology shift. So we have moved very quickly over the last, if you look at it from 2017, we moved to BS3 to BS6. So as things go forward and with the focus on environment and ESG and polluting and pollution, a lot of corporations are focusing on their supply chain and the attendant pollution reduction possibilities that are there. So we expect that people will start moving to BS6 much faster than what was happening in the BS2, BS3, and possibly BS4 era. This is point number 1. The second point is the replacement demand would also start kicking in because all said and done, vehicles age whether they have run or not. And over the last 2 to 3 years, there has not been much vehicle movement because of the last 2 years. There has not been much movement owing to COVID. But as the economy opens up and people see the risk of COVID coming off, that's the most important thing. I think if you look at it, all of us are just waiting for COVID to become a normal, kind of a disease that can be cured with a, pill or something like that. And we are seeing that happening, getting better and better. Once that happens, we would actually see primary and replacement demand going in. We are keeping in touch with key the customers. We are looking at their fleet age. We are suggesting to them various options that could be available for them to replace it. And they are also saying that let the demand pick up fully and then we would want to replace vehicles. Vipin, would you want to add?
No, I think.
Ladies and gentlemen, the lines of the speakers have got disconnected. Please stay connected while we reconnect the speakers. Ladies and gentlemen, thank you for patiently holding. We now have the lines of the speakers reconnected. Over to you, sir.
I apologize, Vipin Sondhi here. Vipin Sondhi here. We had a small glitch in technology. Just going back to summarize, Hitesh, what Gopal said in actually under 3 points is number 1, economy gaining traction, which is positive. Number 2, the consciousness and the need to go green, which will drive towards BS6 vehicles from BS3 and BS4. And as the scrappage policy comes into vogue, then again, aged fleets will start moving towards better technology and better fuel. So these would be the 3 points for replacement demand in the next few years, articulated by Gopal.
Yeah, and the average age, I just wanted to add, Vipin, was that, as per an ICRA report, if I'm not wrong, the average age of the vehicles is currently at about 9.5 years in FY21, which is almost like the highest that the average age has been over the past few years. FY19, for example, was 8.7. The report says. But of course, these are statistics. But see, directionally, what will happen is at some point in time, there will be a pressure for us, for the industry, the transportation sector, to switch over to later generation vehicles, especially also because most of them are packed with a lot of, technology today for track and trace, for vehicle performance, driver safety. So there's a huge shift that's happening on transportation sector.
Thanks. Can I ask one more question? Just wanted to understand how is the financing situation, because under COVID, actually banks were very reluctant to finance this truck segment because of obvious reasons. But have you seen the animal spirits coming back and people willing to fund this segment now?
Yeah, I think so. You see, after the morat has come off, the moratorium, and then they're seeing that the larger fleet operators and even the smaller fleet operators are actually paying back loans, and the collection efficiencies in this sector in the finance companies have stepped up quite significantly. So the larger players in the financing side have started to open up financing here, because you must understand, when you look at sector financing, especially even in banks, other than normal corporate lending, where would they go to? They have to go to a real estate. They will have to go to commercial vehicle financing. They will have to go to car financing, motorcycle financing, agri financing. So when you do that, this actually is a very preferred segment of financing because of the ticket size and security that is available and the resale value.
Just to add, Hitesh, as we meet heads of banks, they are more and more coming forward to financing, looking at alternatives. And you have to remember now, as Gopal mentioned, the technology which is available for track and trace can actually monitor and secure truck performance at real-time basis. So financier knows exactly where and how the truck that is being financed is doing and where it is physically. So there's a lot of security involved in the new gen trucks. So we see that as a huge positive in the financing situation.
Great. Thank you, Vipin and Gopal. All the best.
Thank you.
Thank you. The next question is from the line of Pramod Kumar from UBS. Please go ahead.
Yeah, thanks a lot for the opportunity. Sir, I had one question on the business side. Before that, I just wanted more clarity on this transaction with OHM Global Mobility. So can you please throw some light on this and just clarify whether this is a sale to a promoter entity or it's still going to be under the ambit of Ashok Leyland? If you can just clarify and throw some light on this transaction.
Yeah, you see, essentially what we're doing, Pramod, is that, we had mentioned that we would want to focus the EV initiatives outside of Ashok Leyland, especially, on the LCV and the bus side. So that's how we had, formed Switch. And if you, I don't know whether you attended the meeting that we had specifically on Switch and the EV initiatives earlier this year. So there, what we had mentioned was we would, Ashok Leyland had started the EV initiative in a very small way about 2-3 years ago. We launched Circuit, and then, we got a couple of orders as well, and then we were, kind of tying up relationships. But we didn't go the whole hog because this business requires a lot of capital investment. So then what was decided was that, before this business starts to acquire significant amount of size and shape and which requires a lot of investment, let us transfer it into Switch. And Switch is, housed in UK, which is held by Optare PLC, and Optare PLC holds approximately about 91 to 92%. Is held by Ashok Leyland. Another 7.5% is held by Hinduja Automotive Limited, and then the balance 0.5% is a very small percentage held by various third-party investors. And it's an unlisted entity today. It's been delisted. Optech Switch has been delisted, not Optech PLC. Optech PLC was always unlisted. Now, what we did after that, if we were to remember, was that we said that Switch UK, and if I may use the term in very simple terms, these are not the exact names of the company, but for the purposes of saving time. So Switch UK will have a subsidiary in India called as Switch India. And that would be I would say the manufacturer for Switch business. It would be the primary manufacturer. There would be other manufacturing locations. And this company would also cater to the Indian and SAARC market, which means sales would happen from Switch India to, the direct sales will happen from Switch India to the Indian market, SAARC attendant markets. And Switch India will also supply to the rest of the world under the Switch umbrella. Now, parallelly, what we did was we wanted to reach the end customer fully, right? So it was not just only for supply. And what we decided to do was that we realized that we need to get into the e-mobility as a service space. And that would mean that the ownership of assets would be with one of the Switch entities, but this would be a pay-per-use kind of an arrangement with customers where they pay as they use. And the market is actually moving towards that. So if you look at some of the STU bids, some of the larger e-commerce companies, all of them would actually want to have a pay-per-use, and these can become win-win arrangements for the OE as well as for the customer, which is why OHM is being formed. OHM is now held under Hinduja Automotive Limited, but it is going to be transferred. The plan is to transfer it to Switch UK, with possibly the HAL owning about 20%, but the balance to be held, majority to be held by Switch. But this is to be done only after the regulatory approvals are done. So until such time, we will have to wait for it, but the larger plan is that. So subject to regulatory approvals, these are our plans.
No, sorry, Gopal, sorry to interrupt, but ultimately it is going to come back to Switch, but 20% ownership will still remain with the promoters. So why go through this route? Switch Mobility is Ashok Leyland subsidiary. The direct transfer could have happened to them. So I'm just trying to understand, is there a regulatory requirement you need to route it like this, or?
Yeah, there is we would need to, we'll come back with that much later to you. But believe me that this is the most appropriate way of doing it.
No, I'm not doubting that. So I'm just trying to understand the logic here. Nothing, but any which ways, I think you're going to share more details on this at a later stage, right?
Absolutely. So all I can share with you at the moment is that we are looking at, let me add a couple of more things. I mean, one is we are looking at raising capital both at Switch UK level as well as in OHM Mobility. There are discussions that the management of Switch is having with Switch and OHM are having with various investors, and we will keep you posted on that as well. But you can be rest assured, one thing that you raised, and this is what I think is the most important part of your question, is it going to be majority owned by Ashok Leyland? The answer is yes.
Okay. So wait for more details on that, Gopal. And going back to the question on the demand side, sir, because the CV cycle was expected to be much more stronger, and I think some of your peers have made statements to the effect that the industry is going to be marginally positive on second half this year versus last year. So I'm just trying to understand while the economic activity is looking up, all of that is great, but it's not exactly translating into great demand for CV volume. So even in that context, is there something which we are missing out in terms of the impact of the GST plus the tonnage increase and the consequent drop in utilization rates? And if you can help us understand where is utilization rate right now as a fleet, and where do you think what is the threshold which it needs to be before replacement demand takes in? And also some comments on DFC as to how we are tracking it. And related to that is CNG, if you can talk about how much is CNG as a percentage of industry volumes and what are Ashok Leyland's plans in more detail. Thank you.
What was the last bit of your question? I didn't understand.
Gopal, CNG.
Okay. Yeah. So essentially, let me attempt to kind of give a broad broad answer to that, and then I'll hand it over to our MD. See, as far as fleet utilization rates are concerned, the reports of various research reports state that the fleet utilization rates are somewhere around, anywhere between 70 to 85%. Some reports say 85%, some say 70%. But I think there is a much larger demand to come in, because what we're seeing happening is most of the industries have started to grow and post very good results, and they are actually posting growth. So that would, if they are posting growth, that would require transportation, right? So that's why you're seeing this. The second thing is, earlier I think Hitesh had asked about the replacement demand, which is also a very important part. That is not yet fully kicked in, but at some point in time it will, because as I had shared with you, the age of the fleets is one of the highest in recent history, at nearly over 9.5 years. So we are going to see that kicker also happening. The reason why the TIV is still not picked up fully is because, please understand, between last year and this year, okay, we have had COVID, which started suddenly in April, and then we had a complete shutdown till maybe July, and then things started to thaw a bit, and then things started to look like improving. Fourth quarter of FY21 was actually kind of a good quarter in relative terms. But then again, what happened is in April of this year, mid-April again till June end, there was a complete shutdown. And then there is a talk about a third wave. And then you're seeing that in Europe, they are talking about a fifth wave, right? China is going through again, certain, impact of COVID again. Now, so when all of this is happening, India is getting better, thankfully. So I think the vaccinations are getting better. They are talking about the second vaccination to be completed. There are mobile vaccination centers to be done, vaccination to be done house to house, which are all very innovative in a country of this size. Now, having said all that, while all these, now cinemas are open, restaurants are open, so people are going out, right? So a lot of even the work from home situation is getting reversed. People need to come to office. Last quarter, I took the call from home. This quarter, I'm actually taking it from office. So what happens is there's a lot of reversal of things that are happening, right? So all of this would need to be converted to demand when confidence builds up. So once this third wave, people see that it's not really something that is going to impact, and then the COVID situation eases out, we believe that there will be a huge demand that will come up, especially on the commercial vehicle side. The second thing that we are not talking about, which is equally important and important for us also from a company perspective, is the bus demand. Today, only now the primary consumers of this bus are STUs, intercity, then you have office, and then you have schools. Now, most of them are shut other than the STUs, which are also operating now, which are operating with very limited passengers. Now the passengers are getting more and more into the buses. So you are seeing STU orders also starting to come. So I think we are at that cusp where if the COVID third wave does not happen, we are going to see an increase in demand. I hope I'll now hand it over to MD.
No, I would second that. Two things: we move goods and we move people. People movement will begin. Schools, colleges will ensure people movement continues. And goods, it's a core industry. As the economy opens, and we know that the economy is opening, we see that happening. Definitely, goods will move, services will move, and trucks will be bought and trucks will move as well. So we are looking at it quite positively. It's just that a little bit of more confidence needs to come back into the market, but the ingredients are all in position now.
Gopal, on the CNG side.
Yeah, on the CNG side, again, very quickly, and I'll hand it to MD, is that, our last year, we have, our focus was on launching, I think, absolutely the state-of-the-art avatar range of products which are modular. And we will see, medium-term benefits on this because of not only the robustness of the product, but the flexibility that it offers customers, the flexibility it offers in manufacturing, and also the steep reduction in complexity for us. All of this will obviously result in productivity improvements. The other focus that we had, which has also paid off very well, is the launch of Bada Dost, which is actually, kind of ramped up our market share, to about 21-22%. So, now we are, looking at launching CNG, which is important, and we should be launching these products in the fourth quarter, and that would enhance our presence in the intermediate commercial vehicle space, where today I believe that CNG demand out of the total ICV demand, the business, is somewhere around anywhere between 40 to 45%. So, MD, over to you.
Yeah, we're going to go right across. So quarter by quarter, we'll be launching new CNG products, with the first set coming out in quarter 4 of this year. That's in a few months from now, and then it will just carry on after that. So we are all set for that after having ensured that the Avtar and the Baratos stabilize and settle down.
Thanks a lot, and wish you all the best. Thank you.
Thank you, Pramod.
Thank you. The next question is from the line of Gunjan Prithyani from Bank of America. Please go ahead.
Yeah, hi. Thanks, team, for taking my question. I had two questions. Firstly, just the extension of this CNG, which you mentioned. Now, if I look at market share, there's clearly been slippage for the last few quarters. Can you give us some sense? Is it only CNG? What is it? The reasons for this market share slippage, and how are we trying to, fix this? Also, in the same context, is it the rising competitive intensity or discounting that's keeping you, away from trying to chase or get the market share back?
Well, I think you have given half the answer, in your question itself. So there are a confluence of factors. The first one is CNG. And sometimes, in a couple of quarters or 2-3 quarters, you do see slip-ups happening in market share. Not slip-ups, reductions in market share. The slip-ups mean there is no control. Reduction means there is a controlled reason for it, right? So we would become competent and competitive on the CNG front as soon as we launch the vehicles, right? So where we have actually grown in market share, of course, has been LCV, which has been an excellent growth posted because of the products that we have launched. And we are still in the LCV side, while I'm digressing, we are still to look at the rest of the country, right? We are not fully pan-India, and once we launch the network on a pan-India basis, then we would actually enhance our LCV presence even further. Coming back to your question, yes, so CNG and ICV presence, the shift we didn't expect the market to shift so much into ICV. Now, this has happened possibly because of the COVID as well, right? So the demand pattern has changed also because of what is happening today. And there has been a lot of focus on e-commerce. When you have that, ICV caters to e-commerce segment quite significantly. So one of the gainers in all of this COVID has been the e-commerce and the, I would say, e-transaction companies. Now, the second reason is also that the demand in the south has not been as heavy as there are 2-3 reasons for it. The demand in the south has not been as significant as in the rest of the country, and we are weighted to the south. This is the second reason. The third reason, on overall MHCV market share, we were and hopefully will be India's top bus manufacturer. And when the bus demand comes up so sharply, a 40,000 unit per annum demand is today hardly about 10,000. So there again, what happens is you need to wait for the market to revive. Having said that, we are very clear about 2 things, and you're going to hear it from our MD also. We are very clear that we would want to grow the share of business with the customer, and we would want to add customers. So that is the primary purpose for which we exist. But at the same time, we have to ensure that we are doing it profitably. So discounting levels had become, quite high. There were a few transactions which we deliberately avoided, but not all. We have been very competitive in the market with a superior product whose total cost of ownership is much, much better than competition. Now, finally, the other thing you must remember, and I'm going to leave it at that for our managing director to talk about, this market share number is, based on what we kind of sell to the dealers. And we would want to ensure that we support the dealers by not pushing significant stock into the pipe. MD, would you want to add something, please?
Yeah, so just to summarize that in 5 points. Number 1, bus. Buses will come back, our share grows straight away. Number 2, the south, as Gopal mentioned, and We are now expanding our dealership network in areas of the north, the east, and the northeast as well. Number 3, the higher tonnage vehicles as the core economy picks up, tippers, tractors, MAVs, where we are extremely strong, will come back as well. Number 4, the Avatar. The Avatar is giving us better fluid economics, which means greater saving and therefore the ability for us to price it better and value sell it. You will find that the total cost of ownership of the Avatar is perhaps the lowest, but the trucks need to run for some time, and that the customers already feeling it, and as more and more feel it, will be value selling the Avatar. And finally, CNG, there's been a shift. We recognize that shift, and we are taking action to get that shift and filling up that shift from Q4 onwards.
Okay. This is helpful. The second question I have is on the margins. Now, clearly there still seems pretty high pressure on the gross margin levels. Could you just give us some sense on, what is the undercovered commodity, in terms of pricing action not taken? Or maybe you can just split it. What has been the commodity hit? What is the magnitude of price hikes taken? And is there an adverse impact of discounting on a Q-on-Q basis? Some sense on how we should be thinking about the margins that we have. Thank you.
We have been possibly one of the few players who have been raising prices, quarter on quarter. And we have done that in all the 3 quarters, including the current quarter where we have raised prices both in trucks and buses and in LCVs as well. You folks do track the steel prices and some of the other commodity, but predominantly steel. And you would have seen the run-up of steel prices that has happened over the last possibly 6 to 7 quarters. We must also remember that all of this is happening in the backdrop of a switchover from BS4 to BS6, where the cost to the vehicle themselves has gone up for all of us, not just for Ashok Leyland, for all the players in the commercial vehicle industry, by at least 20%. And then on the backdrop of it is a COVID situation where demand virtually evaporated. So you are seeing, we are not, the players are not obviously able to recover the full cost increase of the BS4 to BS6 and also the steel price increase combined together. So we'll have, as the demand pulls up, and it starts to go up, I'm sure that the pricing adjustment will happen and we would see the prices going up. This happened. This is what we see from our side. This can't be guaranteed, but this is a logical outcome of higher demand that we foresee as we go forward.
So can you quantify what is the under recovery? If you can give us some sense around that.
It's very difficult for me to actually put a number to it because different models have got different weights of steel and the components. So I would see while we have some internal numbers, it would be very difficult for us to quantify. Believe me.
Okay.
So I'll just add to that the pricing adjustment as the demand picks up, and then a whole host of cost-related activities that the company is undertaking, both in terms of value engineering as well as removing any wastages and improving productivity and quality. So the whole focus is both internal and external to mitigate any of the commodity prices.
Okay, I'll join back. Thank you.
Thank you.
Thank you. The next question is from the line of Kapil Singh from Nomura. Please go ahead. Kapil, your line is unmuted. Please go ahead. Mr. Kapil Singh, your line is unmuted. Please
Hello.
Go ahead.
Yeah, can you hear me?
Yes, sir. Please go ahead.
Yeah. So thanks. Firstly, I wanted to check on demand side, 2 segments. One is exports. We used to sell about 15,000 a year. We are currently running much below that run rate. So some color as to how do you expect outlook for that. Second is on electric products. How many products are we targeting and how much capex is required for us to achieve our ambitions through switch mobility, and what is the overall CapEx target? Thirdly, Gopal, to you, on the operating leverage side, currently volumes are nearly half of where they used to be, and you've been talking about a lot of cost reduction that company has achieved. So if volumes were to double from here, what is the kind of operating leverage, broad range that one could expect from current levels? Thanks.
Okay, now as far as I'll take it from the last one. See, obviously we have, if you look at our expenditures, and there are, we have been taking action on almost all key buckets of expenditure, including on material, where there are special teams set up for taking out cost, through alternative design or alternative materials, which will not have an impact on the vehicle performance or efficiency or sturdiness. But there are ways to take cost out of vehicles continuously. That's what all automotive companies do. The second one is on all the other costs. We have been running programs continuously, and there is always opportunity for us to take cost out. Now, when the volumes double, obviously you will see a much better operating leverage coming in. It's very difficult to kind of give a number in an open call like this, because one needs to be very, very careful and measured when setting expectations. But all you can tell is that let me put it this way, once a company starts to keep focusing on costs and working capital and cash flow continuously and assiduously, when the revenues start to go up and the realizations start to improve, a predominant part of that realization will fall straight to the bottom, and you can do your calculations yourself. As far as Switch and the home is concerned, I think the investments that will be required for this will be, we will share more details about Switch and home separately, but all we can tell you is that at the moment, the plan is to look at raising capital and debt independently on these companies by the management of these companies, and to manage it. So this would not be something that, at the moment at least, we are not pursuing any major equity investments from Ashok Leyland into these companies. The first question was on exports. I think I'm going to let Vipin talk about it as well, and the initiatives that we're taking. Over to you.
So exports pick up as these markets pick up. So if you look at market share, which is important during a COVID period or during a low period, we've gained everywhere. But I wanted to just mention to you the initiatives we are taking, especially in Africa. Of course, Bangladesh, we have a huge presence, as well as in Sri Lanka and Nepal. But in Africa, we are appointing and continue to appoint distributors who are sons of the soil, who are large businesses, who know their businesses, who have done automobiles, not competitive, but done two-wheelers and passenger vehicles with Indian companies. We've appointed about 8 or 10, as far as I remember, in clusters in Africa. At the moment, we've already started taking orders from some of these, but otherwise testing of vehicles is on. And these will be very predominant in the retail market. We were very strong in the project market. Those will continue. But the retail segment is going to pick up. Now, you mentioned a figure of 15,000 at some point in time. Yes, those were heady days especially for Bangladesh. But we are back to over 1,000 vehicles a month now from October. And we will be taking it forward from there to 1,250 and then on. What is important is that the base has been laid in Africa and in the Middle East while strengthening our position in the SAARC countries. And final point, we have a much larger bouquet of products now with the Avtar and the Dost family that is both packaged for left-hand drive and right-hand drive, as well as the buses. The Ghazal especially, which was launched in the Middle East, very well received. So today we have a much larger presence in terms of the bouquet of products, and we see this as a huge positive in the next 6 months. You'll see a substantial difference in the numbers.
Thank you, sir. Great to hear that. That's all from my side.
Thank you, Kapil.
Thank you. The next question is from the line of Jinesh Gandhi from Motilal Oswal Financial Services. Please go ahead.
Hi, sir. Most of my questions have been answered. Just two of remaining questions. One is on the switch mobility side, we have talked about order wins in India. So can you talk about which products are we referring to? I believe we also have electric LCVs as well in India. So can you throw more light on that? And secondly, if you can talk about HLFL's second quarter performance or first half performance, whatever.
Sure. As far as switch mobility is concerned, I think, we will be, you will hear about the order that has been received shortly. So I don't want to steal the thunder from the switch management on that. So they've been doing a good job in kind of getting orders from, various STUs. And this build-up has been built steadily and methodically, let me put it that way. Right. Now, the second part of it is on your HLFL, on HLFL, sorry. On HLFL, and the question on HLFL, the revenues for, the half year, the company has been doing exceedingly well, and the ratios are improving significantly. And there's the overall revenues was 1,320 crore. The PAT was 10% at 135. There is sufficient provisioning at the moment in the balance sheet. It's an independently managed company. We have the provisions of nearly 323 crores. And the key ratio, the yield on advances are about 13.2%. And the NNPA is at about 2.7%. So I would say that the company is doing very well, and it's got a pretty diversified portfolio. Maybe about 35 to 40% of its portfolio is trucks of Ashok Leyland, trucks and buses. But the rest of it is quite well spread with three-wheelers, two-wheelers, off-road application, and then loan against property, and also buying of various asset classes.
Okay, and can you talk about electric LCVs of Switch Mobility? Are we also getting orders on that side?
Well, we have got a lot of expression of interest, and we are the products are on the verge of I would say final releases. We will share more with you, but very clearly I can share one thing I can share with you is that you will hear a lot more from Switch on both e-buses and e-LCVs.
Got it. Thanks and all the best.
Thank you. The next question is from the line of Binay Singh from Morgan Stanley. Please go ahead.
Hi team, thanks for the opportunity. I'll just go back to mobility as a service business, Om, for you. So we talked about it as one of the pillars for Switch Mobility. So after all the transaction is over, what will be Ashok Leyland's stake in Om?
See, we will share all the details with you. All I can tell you at the moment, okay, we are focused more on the building of the business and the capability. You've seen that we've made some recent hires. There's a lot of, business development activities that are going on. There are a lot of synergies also which Ashok Leyland will bring to the table in terms of, the
correct
network and market relationships that we have. All I can tell you at the moment, instead of getting into specific stakeholding, shareholding, in fact, I will possibly put it this way. Very clearly, the idea is to ensure that Ashok Leyland is the majority owner in that company. Okay? And I would actually leave it at that at this stage. Let us see. The reason why we don't want to share all of this at the moment is because we have to get regulatory approvals. So until we get it, I wouldn't want to share any, statistics here because it would be inappropriate on our part to do that.